Good morning, guys. Good morning again. If you join just for now, my name is Johnbosco with LPT Realty. Thanks for joining and spending some time on a Saturday morning with us. Um, we just redid the day one because we had a technical issue on day one. If you were there, thank you for attending, or if you dinner 10 probably we are going to be posting this in Facebook or and YouTube eventually in the recording so you can take a look at it and we'll send you a email with the links. Okay, just to give you an idea what I am and what after real estate. My name is John Bosco with LPT Realty. Um, I am the founder of Apto Real Estate Group, which is an investing arm. What I do, we do nationwide, primarily strong yield secondary markets to steady landlord-friendly metros. Okay. When I say landlord-friendly, we specifically look for the regulation and um primarily the regulations we look for to make sure, and also the real estate tax, because real estate tax is higher, your cash flow goes down, okay, where net income goes down too. So that's where we primarily, and what we focus on, we primarily focus on three things when we do investment in after real estate. We do sourcing, um, clean underwriting, so we have the maximum profit from the investment, and the execution of the investment, how we execute over the time. Evaluating quarterly, we have a strict method to follow. Every 3 months, we go evaluate and not just the investment, the market, and everything. So if we have to get out, we get out if we foresee something down the road. Okay. Just wearing my realtor hat in LPT. My team uses LPT Power Tools and Power Packs, which is enterprise grade data and marketing tools. Okay. And also, we have our proprietary 11-day launch to sold program, which is basically it treats each listing like a product launch. If you look at your iPhone product, how they launch, it's kind of a product launch. Whether you sell a property or investment, it's a product. Okay, there you are looking for buyers and you market and get the maximum price for it, right? So we focus on that with the pre-marketing and pricing psychology. We use psychology as a psychometrics to set the pricing, and that way we can create higher number of offers and competition. Okay, also we do concentrated showing windows um, that clearly drives urgency and social proof. Okay. Just for regular home buyers and sellers, we are truly a full service if you want to take a look at that way. Okay. And what it means is it includes we post closing help because we do everything like everybody else. From start to finish up the closing, but we also provide full support after closing, vendor coordination anytime, call any of our clients, call and ask for it from anywhere because we have contacts and other investors through after real estate group. We have contacts in any most other local metros and local places, so we can get the right vendor to any of our clients even if they moved to the west coast. Okay, so also we do 30-day check-in just to make sure whether everything is with good or they have any issues, help them with navigating local township rules or whatever paperwork. Okay, so all those. So we primarily call ourselves full service because of that. Talking of this series is not going to be about selling your home, buying your home. It's primarily about your investment, real estate investment specifically, because it is one instrument. Real estate is one instrument you can do for your investments, like stocks, like gold, or anything, right? Or crypto, whatever. So this is another instrument, okay? Just a quick, what we do, day one, we just did again this morning, 9:30. What is real estate and what are the strategies? Now we are going to talk about a little bit how to do basic math, so you understand. You are not going to be doing the full-blown math, okay? We are not going to be doing that here. I just want to give an idea, then we can help we do help our clients and our joint venture investors to do the full blown. Okay. But as a regular passive investor, what are the things do you need? Basic information to determine whether investment you are buying, looking into buying a property for rental, whatever, right? How do you do? The first one is cap rate, obviously. Second one is cash on cash return. How much cash you put in, not price. How much you paid for it is not. That's not your money, right? If unless you pay 100% cash purchase, then yeah, that's all your money. But if you have a loan and 25% is what your money, so what does that bring in? That's cash on cash. Then DSCR, debt ratio. So that where that one is, if you understand DSCR, you can determine whether you will get a loan. Okay, even before talking to a loan officer. Okay. Break even. What is your break even? If I have this much rent, and this much expense, and this much expense, and this is what I need for capex, opex, everything. What is my break even rent should be, and the price should be, and all those. Okay. Uh, then day three, that's what we are going to talk about day two today. Day three is quickly, it's find and fund. You find the deals. Where do you find the deals and how you find it? There are different things, and we are going to be focusing mainly on a passive investor, not active investor. Passive investor meaning you have a job, 9 to 5 job, and you have money, and you want to decide you want to put in. You decided you want to put the money in real estate as a real estate investor. So how do you fund it? Okay. How do you find it? That's what it is about. Then the fourth day, making you did the purchase, you decided you want to go in, did the purchase, and how do you make your investment ready for rent, and how do you execute the whole rental process? Okay. Moving on, just to I already mentioned cap rate, cash on cash return, DSCR, break even, and we'll do a little bit live underwrite what you that way you know what we mean by underwriting, because you as an investor need to do basic underwriting so you know whether the deal is going to be a good deal, and whether you can fund the deal. Okay, so build the buy box. I call the buy box is basically where what is your goal? This is your criteria. Build a box, so you stay in the box. Thinking of going outside the box wastes your time. It's a waste of time because you don't. Time is usually a kind of you have only 24 hours in a day. Okay. Um, just to give an idea of what a cap rate means and what a cash on cash. How do you calculate? A cap rate is basically net operating income divided by price. Okay, that is what gives you a cap rate. When we say net operating income, it does not include the loan payment. PI, the principal and interest, in the loan payment is not included in net operating income. Okay, that is always considered outside. So cap rate is assuming you are paying all cash. Okay, so let's say your net operating income for the year is 18,000 and the price is 300,000. The cap rate is 6% at that point. So when somebody says cap rate, this is what it means. Okay, you can actually go and figure out if, let's say, they have a price 300,000 and the cap rate 6%, you just do the math, price divided by price 6% of the price is your net operating income. Now you can generate because it's like mathematical algorithm, right? So arithmetic you do and come up with whatever is missing number. Okay, if somebody gives you only two, you come up with the third one. Cash on cash again. As I mentioned, it is the final net income. If you have loan, that is included. That is what the money you have to look for, right? You invested. Let's say you bought a property for 300,000 and put 20,000 at 20% down, which is 600K. Okay, normally it is 25%. I just put it for easy purpose, easy calculation. Okay, so your 60,000 is your money. Okay, probably it's the 60,000. It is rounded up, not just the down payment. So anything you spend, the closing costs, the fees you paid, the repairs you did to get ready. Okay, all those together is your initial investment. Okay, when we say initial investment, that's the money you put from your pocket, which is 60K, let's assume. Okay, and the cash flow is 4,800, which means you are getting a cash flow of $400 a month, assuming. Okay, so now your cash on cash return, when you look at it, how do you calculate your annual? Because always when you do calculation, it is going to be annualized. Okay, it's not monthly, it is not over the period, it's an annualized. That's what when you get a mortgage, the APR means, right? It's an annual percentage. You have to look at it that way. In this case, the cash on cash is going to be 8%. Is it a good deal? Probably depends. Okay. If some, how do you evaluate? You have to have a base. My base, I normally look at it is S&P 500 ETF fund and an average over the years. Each year it varies. Okay, but we are not looking into yeah, putting money and taking out, putting money and taking out. We are looking at over a period of time. That's when we take out, right? The average is 7%. So anything over 7%, that's a good deal for me. Good cash on cash, not deal. Let me make it clear. That's how you have to set your base. Some people can say, okay, 5% is more than enough. That is good. That's good for that person, not everybody. So each one has to decide what is your base that you need to have. That's where the buy box comes in. So all those will fit in the box. Okay. Quick formulas that you will be using is the NOI we just talked about, cap rate. Like I said, the NOI, gross scheduled rent. We haven't talked about the vacancy. When you get into a deal, beginning of the year, you are saying, okay, this is I have the lease for $2,000 a month. The scheduled rent is 24,000, right? Maybe the renter has a problem, didn't pay, late payment or vacancy, whatever happens. That will be calculated at the year end, not when you go in. Okay. Um, then other income, anything you may have, let's say you have a washer and coin operated washer and dryer in the unit. That is other income, right? So any other income that's associated to that particular investment. Then vacancy allowance we just talked about, then operating expense. And if you look at it again, excludes mortgage, principal and interest payment, and it includes I should say it includes income tax. Sorry about that. Then cash on cash, we talked about cap rate, we talked about DSCR. Um, Basically, it is what banks usually use DSCR too, okay, because it's your debt ratio, okay, your income versus debt ratio. So it is not your personal income. When it comes to investment, they'll look at the investment, okay, unless you are buying it under your um, whatever the way you structure it, okay, second home. If you buy it as a second home, that's a little bit different, but still they look at the DSCR for that. How do they do it? They look at the net operating income, then your annualized debt service, how much debt you are going to have. That is the percentage. Normally, DSCR should be around 1.5 to 1.2. If it is over, it's not a good deal. Under, it's a good. They'll look at a little bit more, okay? Because that's if it is way under, doesn't mean it's a good deal either, because they look at some other things too, because that's the reason that's way too low. Um, then the break-even occupancy. How much? What is your break-even occupancy? You have you can have vacancy. Let's say the break-even is 1 month. That is where you got to keep your investment at maximum 1 month. Otherwise, you are going to be losing money. Okay. How do you calculate your OPEX plus debt service, which includes your PI, principal and interest you paid, plus your gross potential rent. That is your break-even occupancy rate. Okay. Then break-even rent same way. Okay, and we do it by month and they were at the by month because that's rent is always for a residential rent. It's always by month. Okay, so. Um, If you have any question, just post it in the chat. We'll talk about it. Take a look at it after the at the end of the webinar. Okay. Moving on to DSCR and break even. That's the lender. Like I said, it's from the lender eyesight. Okay, lender will look at it, look at those specifically, and you can sleep at night well too because you are not worried about it. Okay. That's one of the reason I recommend any first time investor not to buy 100% because when you go to take a loan, the bank is doing their math, which is a second pair of eyes, making sure you have a good investment. So that is always a good thing. Okay. So I always recommend get a loan. That way the bank who knows the numbers, how to run the numbers, probably knows about the locality better than you. That's the second paragraph, maybe third paragraph. If you are working with me, I might say, but you have a third pair of eyes that telling you whether it's a good deal or not. Okay. When bank says you cannot get down, don't go into a deal because there is a problem. You miss something in the calculation. Again, net income NOI is 2100, 21,600. PNI comes for the year is 16,800. If you want to calculate the DSCR, that's 1.29. Okay. Let's say rent goes down 100 per unit. It is a duplex. The net operating income will fall to 19,200. In this case, DSCR falls to 1.14. Right? That is borderline. We can work with that as long as you have enough reserve because they'll be looking for reserves to support lower DSCR, right? Do you have enough money? That's one of the reasons they may ask you to provide your personal financial statement. Okay. Then the break even occupancy, if GPR is 24,000 and OPEX and PNI equal 20,000, it's 85% is your occupancy rate. So which means you can survey with the 15% vacancy, still break even, not lose money. What does that mean? In a 12-month, you can have a little over 2 months vacant. So you can rent only for 10 months. Still, you won't, uh, you'll, you'll be break even. Okay. Assuming you didn't spend all the money and that you received the cash flow. But we are doing a regular financial statement. Okay. Um, the next one, DSCR, that's just a quick check. It normally it is good. DSCR greater than 1.2 is most likely first time investor need. The bank will need to make sure uh, the DSCR is higher because you do not have the experience of running a rental at that point, running an investment real estate, right? So you are required to have a little bit that way they are reducing their risk to provide you the money. Um, 1.15 to 1.2 is often once you have more than one residential, they are comfortable. They know you have experience, gained experience, so it should be workable. Below 1.15, you got to have some kind of reserve to support it. Okay, you have to have significant reserve, and they may ask you whatever to cover that. Okay, you can still workable, but the bank will look for ways to reduce their risk. Okay, let's move on. We talked about adjusting the knobs. Okay, what are the things we can adjust? Rent we can adjust, increase, lower, tax and insurance. We cannot adjust that. Insurance you can shop around. Taxes you don't have control over, right? Vacancy we talked about, we can control. Property management, if you have a property management to proper manage the property, what are the cash? We can adjust that because depending on you can shop around, but at the end of the day, you are not just shopping around for the cheapest. You need good service too, right? So also, if you have more properties, they'll give you a discount. So all those are adjustable, right? And then repair and capex expense, you can adjust. That's under your control. You decide whether you want to repair or you want to spend full all the money in fund the capex and replace the whole thing. Rate and term, uh, it is little bit negotiable depending on your experience and your relationship with the bank. Okay, that's one of the main reason we have to build a relation. But with one property or two properties, it's hard to build a relationship because you are just a customer at that point, right? Then insurance again can be you can shop around. Okay. Let's take the example. Let's assume the $100 rent, $100 more rent will lift the cash on cash to 7.2%, from 7.2% to 9%. That can happen, right? That's one of the levers. Let's say the interest rate drop by 1%. The interest rate increases by 1%, right? If you are paying 7.5 instead of 6.5, it'll bring down the cash on cash because your net income at the net income, not net operating income, net income at the end of the year goes down because you paid more on interest. Okay. Let's take the scenario. We purchased a property 300,000. put 25% down. The loan is 225K. Assume 7%, 30-year loan, because probably that's what you are going to pay in this market as a first-time investor. Okay. And plus 1% for that particular scenario would be 8% per interest rate, right? That one is about $155 a month more on interest, and it's about $1,860 in the year from cash flow. Your cash flow goes down, which means your cash on cash goes down. Right? Let's assume you're paying the interest rate drops to 6% and you go and refinance. At that point, you would refinance in this case, right? Because you are saving $149 you are getting saving, which means it's $1,788 a year more in your cash flow. So your cash on cash goes up. So what do you do? That's what you should be doing, right? You have to evaluate your investment every year at least, not like us every 3 months, to determine, can I increase my cash flow? Can I increase my I, right? Which means you are reducing expense somewhere, and you have to evaluate that, right? So you have to always have the box uh, built once, update. It's a live box after that. So the box needs to be always updated, right? So in this case, if cash in is 75K, then your 1% down rate increases cash on cash by 2.4%. That is a really good deal, right? If that happens. So I put this one just to get you and because people try to look at a deal and do all the math we talked about. You don't have to. Okay. If you ever heard of 1% rule, that is a crude, I put it as a crude. It used to work for most of the time, 99% before, but now with the higher tax, real estate tax and insurance, it is not exactly okay. What it means is if a property is, let's say, 300,000, the rent needs to be around 3,000, maybe 2,800, 700. Okay, if the rent in that area for the property is only 2,500, probably not a good deal. So why waste the time? Unless you know you can reduce the price. Most of the time in that case, yeah, if there are situations, you might know from your experience or my experience or as an investor, how you can get a lower price, whether it's even possible in a property based on certain criteria. Okay, we have experience, right? What the market is and other things that we look for. If it is worth, can I reduce the price to 270,000? Then 2,500 might be okay. That might fit into my 1% rule. I can do the rest, additional calculation, additional look. If I know for sure it is not, that place is listed, the price is probably people are going to be paying 310,000 to buy. I'm not going to be able to get, why spend my time even look at it, right? That's what the 1% rule comes in, okay, to as a first step. That's how I do. Okay, then we look at rent to price, which is pretty much what I just explained, right? How much rent and what is the percentage, and if it is near the 1% rule, right? Then the gross rent margin, right? GRM is something that mostly used in the commercial real estate, but what it is your price divided by. So probably when you are going to buy a single family, it's not going to be that much applicable. When you say GRM, yeah, it normally is not in the terminology in the residential single family home sales. Okay. Let's take a quick look at it. Let's say the price of the property is 200,000. Scenario A, rent is 2,000. It's 1% rule. GRM is 8.33. Scenario B, rent is 1,900 and which is 22,800 per year. GRM is 8.77. Again, we are always annualizing when we do percentage. Okay, which what does this mean? A lower GRM. If you look at the purposely given the numbers, if you look at the GRM for scenario A and B, lower, which always tells you have more cash flow. So that is better than B. So when you evaluate two deals, because it's not just one available in the market, you are going to be evaluating one or two, three more, right? Which one gives you the best? So here is the simple thing you can look. But I want to warn you, scenario A, B may be lower, higher GRM, but it may be in the best neighborhood where the vacancy is, let's say, less than 5%. Scenario A, the vacancy may be 10%. Then you are better off going with the scenario B. So this one is just a basic, quick math, mental math. If you ever looked at the shows, the investor shows, how do they do it? They sit there, ask question, and they say, I want to invest in, I don't want to. This is how they do mental math. So it gets done. Then they go and do the full analysis. You do the same thing, right? How do you underwrite? What are the inputs? And let's take a quick look at it. Let's say uh, I'm, I wanted to do live one, but I don't want to because I don't have currently anything in the local area listed that will fit as a investment property. So let's assume it is a duplex. Unit A market rent is 1,250. Unit B 11,000. The gross scheduled rent is $2,250 per month, and the taxes are 3,600 per year. Insurance 1,500. Um, let's assume the utilities are separate, metered, so renters pay for everything. We don't, as a landlord, doesn't have to worry about the utility. Purchase price is 300,000, right? So here is what the input to your underwriting. You need to know your rents, vacancy percentage in that area. Normally, most of the agents can give you, most of the knowledgeable agent can give you what the vacancy rate is in that particular neighborhood, because sometimes real estate is hyper local. It may be a block, two blocks when it comes to city, right? So you have to know at that level, not zip code level. Uh, because if you look at probably zip code level, you can look at an Zillow or somewhere or get that vacancy percentage, but that may not be directly applicable to that particular property. Okay. The other income, if you have any, in this case, we are assuming $0, then the management to be easier, we are saying 10% of the gross rent is the property management in expense. Let's say we are just saying $100 a month for repairs and maintenance. It may vary by month. Some months it may be there, some months it may not be. So, but we are allocating 1,200 per year for in this case. Taxes again, insurance per month is 425. If you look at 3,600 plus 1,500, so it comes around $425 a month. Um, then rate, we are saying interest rates on person and 30 year. Um, amortization. So I'm going to say amortization because depends on what type of loan you have. It may be 30-year loan. The loan term is sometimes commercial loans are 7 to 10 years, but amortization can be 30 years. Okay. Down payment, we are doing 25% minimum, probably minimum required by most banks, most lenders. Closing and initial repairs, which includes painting and all those. Let's assume it is going to be 6%, 6,000 closing costs and 4,000 to get the property ready. Okay, first let's our EGI. Okay, effective gross income for that property is per month we normally calculate, which is basically you are going to do occupancy rate, which is 95%. So 95% is what your effective gross income is. Okay. Now moving on to OPEX. Okay, what is an OPEX? Operating expense. So it is an expense incurred operating that rental unit. We are talking, like I mentioned earlier, it may be real estate investment, it may be a property, but at the end of the day, treat it like a business. So OPEX. Right. OPEX is basically a property management plus any repair you had, taxes and insurance, which comes around 739. Net operating income is basically your monthly rent minus OPEX, okay, which is 3,900, sorry, 1,399 per month. Then loan, we are taking loan, doing 25% down, so the loan is 225. P&I for that would be at 7%, 30-year amortization would be 1,011 per month. So your cash flow is basically your net operating income minus your P&I, which is comes to 388 per month. Okay, so if you do the cash on cash, 75,000 you put in and 3,800, 3,088, which probably 12 for the year, you are looking at around 4,000 something. So your cash on cash is 7.0%. And DSCR is going to be 1.38, which is really good because of the 389, $388. That's really good number, right? So this is how you underwrite. Now you know for sure you can get loan. You have a good deal. Cash on cash is 7%. Good neighborhoods, so probably appreciation is going to be good. I'm going to say 3%. National average is 5. If you are investing in Chester County, average over 20-year period is 3%, around 3%. Okay. And your tax benefits. Now let's take the same property, do a little bit different math. Let's say the rent goes is only 1,100. Here we had 1,250. Unit A goes down by at $100. Unit B we are reducing down to yeah $50. Okay, so doing all the math. I'm not going to go over the math because we already looked at it. We'll go here, cash on cash in this case goes down to 4.7%. Now you know how that when we talk about adjusting the knobs, adjusting the rent, can adjust the cash flow and the DSCR. Okay. But same time, you cannot just say if the market can take only market gives you only 1,250, you cannot just go and say 1,400, which means your vacancy goes up. So there are some things you got to determine how you have to adjust it. Okay. And DSCR in this case goes down to 1.26, which is good, right? You are going to be able to get loan. So sometimes during a certain period, whatever happened, let's say there's a recession, obviously the rent is going to be a little lower, right? and your cash on cash at that point is going to be lower. But you know you have good DSCR still. So after the recession, 2 years, whatever it takes, 3 years, um, the rents will go up, right? In that, and you have a good renter that is not going to really leave next 2 3 years. You you made it see it as a good investment, depending on your box, what you define. Okay. Basically, we talked about the buying box. What should be in your box? Okay, the price band. I call it price band. It's basically what is the price range you should be looking for. You cannot say just I'm fine trying to find something. Even if you can afford a $500,000 in a particular market, if the numbers will work only if the property is around 300,000, why you look at a $500,000, which probably will break everything, right? So all your calculation will be in negative, won't be good. So in that case, you will say, okay, this is what my pricing band is between this price to that price. And I said real estate is local, which means this you have to know which submarkets you sometimes people come and say, I want to buy something in anywhere in Philadelphia. My answer is no, because you have to have which neighborhood level or at least the zip code level. This is the zip code I'm looking for. This is the neighborhood I'm looking for. This is the township I'm looking for, right? That's the submarkets. And how many beds and baths do you want? What is the average goes in the neighborhood, right? Some neighborhoods only one bedroom goes because it's mostly single in the demographics. So they need just one bedroom. Some have families, they may need three, right? Probably anything over 3 bedrooms is not going to be a rental. Usually it is a unique renter or they um, so 3 bedroom is probably, I would say, the maximum. And more than one bath in any unit, except for studios, is really good. Okay, even if it is a single bedroom, one and a half may be good because if a couple are living there, they have two bathrooms to use, and that is a good thing. That is a good feature to have more, at least one and a half bath in any unit. Okay. Sometimes you cannot have it, that's fine, but that's what it is, okay? Then utilities. Do you want to pay for it? Are you okay paying utilities yourself, or you want the utilities to be included in the rent or the paid by the tenant? You got to decide that, okay? What do you want to do? Okay. That is what you want to do. There's no right or wrong answer. Okay, sometimes some landlords pay because that is easier to say, right? Easier to tell the potential renter. If I say $2,000 and everything is included, that gives them what their monthly expense is going to be, rent expense, right? If you tell them it's 1700 and electricity and water is separate, sometimes some renters are they don't know, they cannot expect, and they may be under expecting because they may have thought it will cost only $100, but it may be actually $250, which each from their income that they get, right? So if they are not prepared for that, there may be a problem paying rent. Okay. Um, then the condition of the property, how do you want it? Are you okay? You want everything moving ready? Probably that's not going to be a good ideal one because at that point you are paying over the market price because somebody prepared it for you, right? They got to get their profit too. But going to be moving ready, or are you just going, okay, just painting, doing cosmetic painting on all those and and rent it, or you are okay with doing complete gut renovation, right? Some people are okay with that, and they have enough capital. 6 months takes about, let's say, it takes about 4 months. They have capital for 6 months to manage that, and they know good. General contractor that can handle it. Yeah, that's your box, right? What you are comfortable, you have to define, and what your target return, which means I need to have my base. My base is always S&P 500 ETF, which is 7%. I gotta have above that. You can say 5%, 4%, 12%. You cannot be unrealistic, if you want to call it. If you are going to sit there and say 15%, probably you are unrealistic at that point. Okay, and that's like I'm waiting for a good deal. Then what are the deal killers? If these things are there, I don't want that property, right? You got to define that. It depends on the individual. You have to define, and if you are working with me, I can help identify, but it is at the end of the day, you got to decide what is a deal killer is for you. Okay. Let's take a quick example here. A duplex. This is one a buy box for somebody I put together recently. It's going to be 225 to 325 duplex, 2 and 1 unit. Okay. Sorry, two bedroom and one bath units, minimum. Separate utilities, okay, in both units, so the tenant pays for it. The building should be built after 1950, whatever reason it is. We came up with that, okay, and it's going to be South Philly and Birdsburg neighborhood specific. Okay, this person was not looking for anything beyond that. Even if I send says not does not fit my criteria, that's how it should be. Okay, if you are doing it, you are wasting your time. You could be doing something else that generates money, or your family's time is important, right? So the next one is it needs to be minimum 7% cash on cash. DSCR should be 1.2 for whatever reason we did that. Well, specific reason, not whatever. That particular individual needed. Okay, for his situation. And no knob and tube, which is basically the old electrical. Probably if you look into old houses back in 1900s, they probably have knob and tube, which can cause fire. That is one of the reason this person said 1950 and above the building year built is. Okay, and they didn't want oil heat for safety reason. Okay, because they didn't want to be spending time trying to figure when to fill up the tank and all those, because they are not there. They got to depend on the renter to tell them, but they didn't want to take the risk. Okay, so that is their build box. So you got to build your box before going in. So you are setting up yourself for success. It's a step-by-step process. You cannot just go and say, this looks good and I'm buying it, then figure out what am I getting into, right? Or complaining about somebody didn't help you. Okay. Again, that's what I wanted to talk about. So it gives you an idea how you can do. And most other formulas I showed here, you can find it anywhere in the internet. Probably there are some Excel spreadsheet or formula calculators you can find online too. How do we help our client from LPT Realty team? My team as a realtor team for our investor clients, we help one-on-one underwrite, sit with them and provide them what they need to and see difference and maybe two or three scenarios we can show to compare. And rent comp, what is the average rent and what's the best rent you can get for to get lower the vacancy and all those, right? Then the offer kit. How do we put an offer that wins? That is always important, right? The person who is selling the investment property should be comfortable saying, I'm getting a good deal, right? So that's how we set up our offer, and we create customized for each one. It's not going to be not even each person, each property. That's what I would say, right? Then custom property alert, specifically if what the investor needs to see, not beyond. Okay, and even if they come and say if something that doesn't fit, and they say, can we look at it? We, as a consultant, we provide our input, why it may not fit for them. Then eventually they got to decide whether they still want to go forward with it. We are okay with it. If they know and they decide to, as an investor, you decide to go in, that means you are okay with certain risk or you know how to handle it. Okay. So there's no right or wrong at the, like I said, never anything is wrong. It is how you are as an investor, you are comfortable with. Again, here is my contact. If you have any question, you can send me a text or email and set up a time with me. I think with that, I'll finish my day two presentation. Sorry, it took longer because I figured it might take a little longer talking about the calculations. Okay. If anybody have question, I'll stay for 5 minutes. Thank you for joining us. Have a wonderful weekend, a wonderful Saturday and weekend. Enjoy yeah, the time with your family and friends. Thank you.